Traditional banks are pulling back from lending on non-residential and mixed-use commercial projects. For boutique developers, this creates a liquidity trap. They find themselves holding significant equity in existing properties, but they lack the liquid cash required to break ground on new projects. A New Jersey portfolio shows this tension: a stabilized mixed-use building in Lodi and a vacant lot in Wayne. Lodi holds substantial equity but a high-interest mortgage. Wayne is owned outright but stalled without construction capital. The developer's objective is to build 2 new apartments directly above a commercial space on this Wayne lot. The challenge is securing the liquid capital for Wayne without taking on predatory loans, particularly while traditional banks refuse to underwrite the mixed-use building in Lodi. The solution relies on a strategy known as cross-leverage. This involves restructuring debt on one stabilized asset to lower its carrying costs and extracting the specific cash needed to fund a new development on a separate parcel. In this lending environment, the collective equity of a multi-property portfolio serves as the primary source of liquidity through cross-collateralization. To understand the mechanics, we have to map out the financial state of the Lodi property before the refinance. The property currently carries a $470,000 mortgage at a punitive 10 to 11% interest rate. However, the asset side shows $700,000 in trapped equity. The goal is a cash-out refinance that pulls exactly $300,000 in liquid capital out of that equity pool to fund the Wayne construction. Simultaneously, the strategy aims to reduce that 10 to 11% interest rate to a more sustainable level. Success requires staying within a strict structural constraint, the 70% loan-to-value, or LTV, threshold. Staying at or below 70% LTV allows lenders to approve the cash extraction while dropping the interest rate into the single digits. If the cash out pushes the total loan above 70%, the risk profile increases for the lender, which usually negates any potential interest rate savings for the developer. Once construction is complete and the Wayne property is generating income, the developer can then execute a 30-year mortgage wrap to stabilize the newly acquired debt long-term. This mathematical balance converts stagnant property equity into the primary funding source for the new build. Optimizing existing debt structure is often the most cost-effective first step in ground-up development, performing better than taking out new mezzanine debt. If traditional banks won't lend on mixed-use real estate, we must identify who is actually funding this 70% LTV refinance. The capital comes from alternative, non-qualified mortgage or non-QM, private investor loans. It's important to distinguish this from hard money. On the left, hard money, short terms, high rates. On the right, non-QM. Non-QM offers 8 to 11% rates, with amortization schedules on shorter timelines than a standard 30-year mortgage. The underwriting logic shifts away from a borrower's personal W-2 income and focuses on asset-based cash flow analysis. The primary metric that dictates the loan terms in this space is the property's rent roll. In the Lodi property, the deal is supported by a single anchor unit generating $4,500 in monthly rent. This leads to unit self-sufficiency. For the refinance to be approved, that $4,500 monthly income must cover the property's restructured debt obligations. The developer can keep 2 other units vacant for future construction only because the anchor unit passes this self-sufficiency test. In alternative commercial lending, a verified and optimized rent roll is more influential than a personal credit score. The Lodi refinance successfully unlocks $300,000 in liquid capital for the portfolio. With the cash secured, the focus moves to the vacant land in Wayne for the capital deployment phase. Liquid cash must be tightly gated by operational milestones to prevent it from being spent inefficiently. The first hurdle is navigating the ongoing municipal zoning and township approvals for the Wayne parcel. Financing documents are prepared in parallel with township meetings, but capital cannot be released until those zoning changes are officially stamped. Once construction begins, the release of that $300,000 is governed by the draw schedule. While banks often have rigid schedules, private investor loans can offer client-controlled draw payouts, giving the developer more influence over the timeline. This control mitigates the risk of contractor defaults or the misappropriation of project funds. The developer dictates the timing and size of the payout, releasing funds only after specific work is verified on the site. Ensuring these payouts are controlled yet timely maintains project momentum and contractor relationships. This ties back to the Lodi loan structure. In many alternative loans, interest is only paid on the capital actually drawn, reducing the carrying costs during the build. Capital extraction is the first step. but rigorous, phase-gated draw control ensures the development reaches completion without draining the developer's resources. Executing a non-QM cash-out refinance on one asset while managing construction on another is a complex operation. Success requires a centralized operational approach to prevent communication breakdowns between lenders, developers, and municipalities. Leveraging equity positions requires speed. Lending teams aim for a 48-hour turnaround to generate financing scenarios and investor feedback. Technical and educational hurdles can stall a deal, from complex financial literacy to simple issues like conference call connectivity. Integrating educational tools with direct team support ensures all parties remain aligned on draw schedules and payout timings. The cross-leverage strategy is finalized once trapped equity is extracted below 70% LTV, legacy interest is eliminated, and funds are released through controlled draws. When traditional capital retreats, developers who master these portfolio mechanics retain the ability to expand regardless of institutional hesitation.